Welcome everyone to the Kendall Report, where I help you manage your portfolios and protect your wealth. Don't forget to subscribe, like, and share these videos. In yesterday's video, I discussed the propaganda machine that the government is running around all of the reports, including possibly cooking the reports a little bit to make them look better than expected. And then next month we'll see downward revisions like we saw in the housing. This time it wasn't the government, but it was the news media hyping up the COVID situation, causing the algorithms and everybody to get a little nervous about the potential of a second wave. Whether that happens or not, that's yet to be seen. It appears to be fairly unlikely, but algos were able to play off of that, pushing the markets sharply lower. Now I'll go through in the technical section, but we moved into that cluster of support levels that I discussed in Monday's video. As we look forward to Thursday's opening, we'll see the release of GDP, which is expected to show a minus 5%. It's likely that we're going to see that number come in at that level, maybe worse. Maybe it'll come in a little better. Like I said, there seems to be some book cooking going on, but I can guarantee you that there will be a circuit on all of the major television shows between the Secretary Treasurer Steve Mnuchin as well as Larry Kudlow and others that will be out there talking about the recovery. Whether it will be able to influence the markets or not, we'll have to see what happens. There is a potential for the market just to flip after yesterday's sharp selling. There really was no basis for the selling as the markets were reacting emotionally to the stories that were being flaunted throughout the news media just about everywhere you looked. Today will be a different day as markets will be focused in on the fundamentals. We'll also have the jobless claims reported, which is expected to show a 1.2 to 1.3 million new filings. We'll see how that all plays out. There will be plenty of emotion around the markets again today. So volatility is kicked up substantially, and we're likely to see some recovery. And I'll go through all of the details here in the technical section. Let's dig into the charts and see what's likely to occur on Thursday. So before getting into the technicals, I want to go through the WaveTech research tool database. I talked about this on the live cast on Wednesday, and I expected to see thousands of sell orders coming in on the daily models, and that's exactly what we saw. Most of them coming in on this daily 1.2. There's 2,547 sell signals coming in. The thing I want you to notice here is that the symbols in the database, the percent bullish is at 70%. This is likely to continue to roll over. Even if the market rebounds today, we're still going to see a liquidation here. And I've been talking about this for the last couple of weeks as we moved into the 90% bullish range. We're going to see a rotation happen in the market. This is going to set up an absolute amazing opportunity. Somewhere between the next 2 and 4 weeks, we're going to see a rotation once this market finds a low or consolidates here, a rotation of a lot of new buy signals coming back into the system. So if you haven't signed up for the WaveTech tool, do so now. You can go to the Kendall Report /WaveTech. Starting with the futures, we're looking at the overnight activity. We traded down to 3020.25. We went just below S1 by a few points. It was a very thin market. I was watching it trade when it sold through, and there wasn't a lot of volume that went through that, and then it reversed back up. And this was exactly what you want to look for, is a reversal off of that S1. Even if it trades through a little bit, we got a nice reversal on the 5 and the 15-minute chart, and that set up a further recovery move, trading up to around 42 from those levels, and we're continuing to be stable. Now it's about an hour and a half from the London opening, and it would be interesting to see if there's some short covering coming in before the GDP report comes out in the morning. This is my expectation. We are likely to see some bidding up of the market just to get neutral. There was a lot of activity and volatility tonight, but not a lot of volume. We're 136,000 contracts. The bigger nights that we have a lot of volatility, we'll see 180,000 as much as 220,000 contracts traded by this point in the session. So it's fairly light volume what we've seen so far. But the configuration suggests that we're trading back down to that 200-day moving average. It's 3,000.87. I talked about this in detail in the live cast that I did on Wednesday, but this pattern is likely to hold here and see a reversal. If you notice, PPM1 is, even on a downtick of 12 handles, is showing a big uptick here. This is to be signaling some sort of recovery back today, possibly trading toward the R1 number, which is 3071. We're still talking futures, 3071 to the 3096 level. Possibility of getting back above 3100. That would not be that hard to achieve. Let's take a look at the cash. And these numbers are a bit different since we went out at the 3050 level. R1 is 3062. And so the possibilities are to go back to R3, 3089, going to the RXT number, which is the extreme for the day, at 3101. On the downside, the critical number is going to be that 200-day moving average on the cash is 3020, and then the extreme number for today of the 2999, and then there's also the 10-week moving average, which is at 2984. If this was to be reached, it would most likely be a spike and a fast reversal from that level. I don't expect to see us trade much below the 3020, and depending on how the report comes out in the morning, we're likely to see possibly a sharply higher opening. The futures rallied after the cash today, so the differential is about 5 handles. So right now we're due to open about 5 or 6 handles lower. Not a big deal. As I said, I expect the London crowd to come in and probably bid this thing just a little bit ahead of the GDP report. We could see quite a bit of activity around GDP, but these numbers I just defined should hold this market, and we should see some stability come back in as we come into Friday's close. The other thing that will be critical today, if the market can close back above 3075 and potentially back over 3100, then this will tell us that this whole pattern is completed. And this was the ABC pattern that I discussed last week. And this is why I talked about on Monday's video as a potential of declining down toward that into that 3060 to 3020 level. Yesterday's low was 3232, just above that number. We closed at 3050. So today will be a critical day, but even if we were to close lower and we hold these numbers I'm talking about, I would expect to see a rebound on Friday and probably in through Monday, Tuesday of next week, just to get a little ahead of what the pattern's likely to look like. There's been a lot of talk around the street discussing this potential rebalancing of these major institutions and pension funds. I don't think this is very realistic. Even though we saw a downtick on treasuries on Wednesday's action, that's probably not from that type of buying since we saw the US dollar go up. And one of the things that I watch closely is if the dollar is going up and interest rates are going down, that's typically foreign buying or flight to quality type buying. That's what I believe we saw yesterday, and we should see the 10-year recover back towards over 0.72, 0.75 again. It closed yesterday at 0.68. So these aren't big moves. We're seeing that flat line that I've been talking about. You can see on the screen here. It absolutely is no trend. The PPMs are still looking higher, so interest rates are likely to move up. So I'm not sure there's some big bid in the bond market coming in and this big rebalancing trade that everybody's talking about. Why you would want to own any type of debt right now would seem absolutely crazy, with the exception that the Fed is backing up these markets. There's just not a lot of upside from a price standpoint and a lot of downside. They're more interested in stability. Looking at the yield curve, I'll show you. You can see that the yield curve is steepened substantially over the last several months, and we're continuing to remain higher. If this was going to be the case, you'd see a flatten here, and we may flatten out a little bit, but I don't think this is a big trade. I'll continue to follow that just to give you some perspective on that. But I just can't imagine the motivation to buy any type of bonds right now. And if we looked at any of the MBSs, any of the muni bonds, all of these things are trading at their highest levels they've been for many months, and it all has to do with the Fed support. So there's just no upside on this trade. There's no reason to rebalance there. And there may be some rebalancing, but I just don't see that as a big trade. Just to tie the two markets together and looking at the US dollar on a daily basis, we're continuing to trade back toward the underside of the 200-day moving average, which is currently at 98.10. I expect that we can move to that level and possibly above it. This suggests, in spite of the potential higher rates, that there's going to be a stronger dollar bid as we go forward. So the entire scenario is mismatched from the aspect of how these two markets are connected. Like I said, that Wednesday's action was a flight to quality, but this is likely to reverse, and the dollar was already heading higher and interest rates were already heading higher in my view over the next several weeks, with the 10-year notes ending up back around 1%, potentially going to 1.2, and the dollar back to 98 to the 99 level, just above the 200-day moving average. The final market to look at here is gold, and there's a lot of cheerleaders around gold right now. When I covered the gold a couple of days ago, I believe that it is going to move higher, but it's disappointing that we don't get follow through. We get 2 or 3 days up at backfills. Looking at the market grid for gold, we're trading at 1789. Right now we're trading just above S1. The low of the session has been 1781, which matches perfectly with S2. S2 is 1780, so we could see an R1 trade, which would tell us we would trade back toward the $1,800 level at 1798. The potential on the upside is still for 1870, and as long as we remain above 1767, this market will be fine. If we were to break below that, there would be some problems with this market. This is the end of the broadcast. I want to thank everybody again that showed up at the live cast. Great fun, 3 hours. I covered a lot of information, so if you want to dig into individual stocks and see what we talked about and you didn't get to watch that broadcast, please do that because there's a lot of information in there. Thanks again for watching. We'll talk to you tomorrow night.